before we ask ourselves whether the European Central Bank can save the system, let us ask ourselves whether it is possible to repay the public debt. We cannot repay the public debt. Repaying this debt would be tantamount to destroying around 2,300 billion euros in 2019 in French public debt alone. That is to say, it would mean removing 2,300 billion euros from the existing currency supply. The contraction of the currency supply would lead to severe deflation. Let us summarize all this in a diagram. Here in the blue oval is the existing currency before the debt is repaid. The orange circle represents the debt. After repayment, part of the currency is used to neutralize the debt. Blue circle. After repayment, only the blue zone remains. There is indeed a contraction of the currency supply which leads to deflation. The idea that the state repurchases part of the debt with existing currency is dangerous in the sense that it leads to a contraction of the means of payment in circulation, and thus to deflation with all the consequences that this represents. The €500 billion rescue plan to revive the economies of the member countries of the European Union of the 10th of April 2020. Let us look at the first stage of the European aid rocket, the ESM with €240 billion. The ESM is the European Stability Mechanism, a Luxembourg institution created in the year 2012, whose purpose is to grant loans to the states of the European Union. The main contributors are Germany, 27%, France, 20%, Italy, 18%, and Spain, 12%. In addition to the €620 billion of state callable capital, the ESM has €80 billion of equity capital. The total amount of the European firewall is therefore €700 billion. This fund has been fed by the member states from 2012 to 2014 according to their wealth. Germany contributed 27%. France contributed 20.2%, as I said earlier, which corresponds to a sum of €143 billion for France alone. I would therefore like to ask you the following question. Is it normal for European states to borrow the currency that they have placed in the European Fund? Imagine that you put your currency in case of a hard blow to the bank. The hard blow arrives and then the banker tells you that you have to borrow the currency that you have deposited in the bank. In addition, there are conditionality clauses for obtaining the ESM. Borrowing states must remedy public deficits by implementing budgetary reforms or face sanctions. Italy obtained access to the ESM credit lines without having to commit to reforms in return, despite the power struggle with the Netherlands. Let's see the second stage of the rocket. The European Investment Bank loans of €200 billion. The EIB is the European Investment Bank. It already grants more than €100 billion in loans to small and medium-sized enterprises. The capital of the European Investment Bank is financed by France to the tune of €47 billion, as are Germany and Italy. Spain contributes €28 billion, the Netherlands and Belgium around €13 billion. Once again, as with the ESM, this is not a question of donations. It is a question of loans. But how long will these loans last and at what rate? Let us now look at the third stage of the rocket. The European Commission's aid of €100 billion. The European Commission would release €100 billion to finance the short-time working measures taken by the European states. Here again, We have no information on the distribution of this aid or loans within the European states. Let us now talk about the Corona bonds. For the moment, there is no agreement on the mutualization of debts within the European Union. This reflects the fracture, the lack of solidarity of the northern countries, Germany, Netherlands, Denmark, Luxembourg, who do not want to pay for the southern European countries, Italy, Spain, Greece, France. What is happening between the European Central Bank and the commercial banks? The European Central Bank injects liquidity in exchange for the sale of government bonds by commercial banks. The European Central Bank hopes that the exchange of created ex nihilo liquidity injections for the purchase of government bonds will provide an incentive for commercial banks to lend to households and private companies, or to buy new government bonds. But there could be liquidity leakages from commercial banks instead of feeding into the real economy to bail out their capital. Falling stock markets have reduced the value of assets held by commercial banks, which are seeing their balance sheets and market capitalization deteriorate significantly. There could also be a flight of liquidity to buy new financial assets. There is no indication that commercial banks will buy new government bonds en masse. They may decide to buy much more lucrative short-term assets such as equities, for example, at knockdown prices. The injection of liquidity by the European Central Bank against the sale of government bonds is called quantitative easing, QE. The initial QE of €1,100 billion launched in 2015 and effective in 2016 was followed by an increase of this QE by €1,600 billion until the end of 2018. €2,000 billion of targeted long-term refinancing operations, 2 to 3 years, over 9 months were also added. Finally, QE2 of €1,050 billion for 2020. Conclusion: €5,750 billion of QE. At the same time, commercial banks' deposits with the European Central Bank increased from €300 billion to €2,000 billion. This is proof that commercial banks are afraid of the risks of illiquidity and insolvency. They want to refloat their ratios, their reserve requirements to face a liquidity crisis of at least 30 days. Consequences of quantitative easing by the European Central Bank. The first consequence is a fall in long-term interest rates. The massive purchase of government bonds on the secondary market by the European Central Bank inevitably lowers bond rates. New issues of government bonds become less attractive than those already in circulation. The second consequence is the depreciation of the euro. The increase in the money supply dilutes the value of the euro in relation to other currencies. Third effect: the increase in the cost of imports. The depreciation of the euro on the foreign exchange market increases the cost of imported goods and services. If these imports have a significant weight in the country's economy, the result is a loss of household purchasing power, which may be reflected in a fall in domestic consumption. If this vicious circle is established, the policy of quantitative easing, far from stimulating domestic demand and production, reinforces the negative effects of deflation. Another consequence of currency devaluation is increased export competitiveness. The depreciation of the euro on the foreign exchange market promotes the sale of export products and services through lower prices of euro area countries' products to potential foreign buyers. Let us look at the balance of trade balance for a few countries in the European Union in 2018. The surpluses: Germany €232.3 billion, the Netherlands €67.1 billion, Ireland 48.2 billion euros, Italy 38.9 billion euros, followed by the Czech Republic, Belgium, Denmark, Hungary, Slovenia and Slovakia. All these countries export more than they import. A fall in the euro on the foreign exchange market favors euro area countries with a surplus trade balance. In particular, Germany, the Netherlands, Ireland, Italy, the Czech Republic and Belgium among others. On the other hand, the currency depreciation of the euro penalizes countries with a trade balance deficit such as France, Greece, Spain and Portugal, among others, where imported goods are more expensive. To understand the problem of bank illiquidity, we need to understand the interbank market. Suppose that part of the bank deposits of Bank 2 migrate to Bank 1 by transfer, for example, and that a larger part of the deposits of Bank 1 migrate to Bank 2. At the end of the day, Bank 1 has a deposit deficit. Due to a lack of liquidity in its assets, it requests a loan from Bank 2. In exchange, Bank 1 deposits as collateral for the govies. Govies are very low-risk government bonds. When the bank loan is repaid, Bank 2 returns the pledged govies. But if Bank 1 defaults on the repayment of the cash granted by Bank 2, then Bank 2 keeps the govies. Let's place ourselves in the case of three players: two commercial banks and the European Central Bank. The bank owns good quality, very low-risk bonds, the govies. Through quantitative easing, QE, the European Central Bank buys back these government bonds in exchange for cash. For liquidity requirements in the event of a bank run, the law requires a fixed liquidity ratio that cannot be pledged. Bank 1 owns bonds of lower quality after the sale of the govies. Since these bonds are of lower quality, Bank 2 can refuse to lend liquidity to Bank 1. As a result, through a new quantitative easing, the government bonds are bought back by the European Central Bank in exchange for the provision of liquidity. What are the risks of this strategy? The European Central Bank could refuse to provide liquidity against questionable bonds of lower quality. The bank would become illiquid and could fail. The second possible risk is that, in the event of bankruptcy, Bank 1 would no longer be able to repay the liquidity loans to Bank 2. Bank 2 would keep lower quality bonds, which would be a dead loss for Bank 2. Bank 2 would in turn become illiquid and insolvent due to the domino effect. Conclusion: long-term business lending is much riskier and less lucrative than market transactions. Indeed, in the event of default, govie bonds are more liquid and more easily monetized than mortgages on plant or industrial equipment, for example. Banks therefore favor speculation in the very short term. Let's analyze the financial markets strategy on bonds. There are two ways to make money with a government bond. The first is to buy a bond and hold it to maturity. For example, I buy a €1,000 bond with a fixed rate of 4% over 10 years. At the end of 10 years, I get back the original €1,000 plus interest of €40 per year over 10 years for a total of €1,400. The second way to make money on a bond is to anticipate, in the short term, a rise in the price of my bond because of the fall in rates. Let's take our example again. I buy a €1,000 bond with a fixed rate of 4% over 10 years. The rates drop to 3%. The new government bonds are less interesting than the ones I hold. so the price of my bond goes up. When I sell it, I make a capital gain. If I was wrong in my expectations and the price of my bond goes down as a result of the rise in interest rates, I'll make a profit. What happens if I always buy the same €1,000 bond with a fixed rate of 4% over 10 years and the rates rise to 5%? This time, the new bonds issued are more interesting than the ones I hold. So the price of my bond goes down. I therefore suffer a loss on the sale. This is the sore point about holding short-term government bonds for resale. The financial markets can suffer heavy losses on the bonds they hold if interest rates rise. To avoid these losses, they will have no choice but to hold these bonds until maturity. But rates on German and French bonds have moved into negative territory. In March 2020, the yield on the German bond was minus 0.86% excluding inflation, even though it is currently low. Let us imagine a purchase in March 2020 of €1,000 of bonds with a yield of minus 1% over 10 years and inflation of 1% over 10 years. I will therefore lose 10% on the €1,000 due to the yield, and minus 10.5% of cumulative inflation over 10 years. So a loss of 20.5% on the €1,000. This means that after 10 years, I will recover €795 out of the €1,000 invested 10 years ago. Conclusion: the financial markets do not invest their money in the long term by incurring losses on the purchase of bonds. They speculate in the short term on a rise in the price of the bonds they hold relative to a fall in interest rates in order to make capital gains. This is a very dangerous game. If interest rates on new government bonds rise, the price of the bonds they hold will fall. This will result in a loss for the sellers. They will have the choice not to sell and keep these bonds until maturity. But if they hold these bonds to maturity and the inflation rate goes up significantly, then they will again suffer losses. In conclusion, in order not to incur losses on the bonds held, interest rates must fall perpetually to maintain this possibility of buying government bonds for resale in the very short term to make capital gains. Scenario 1. Rates go down. Let's imagine that the financial markets hold old bonds. There is a new issue of government bonds with less attractive bonds than the old ones because of the fallen rates. Investors will buy the old bonds and the financial markets will make capital gains. At the same time, they will buy new bonds in anticipation of a fall in interest rates, and therefore a future capital gain on the resale of these new bonds. The European Central Bank, for its part, is buying back old government bonds through its quantitative easing. What happens in the case of a rise in bond yields? Scenario 2. The financial markets still have the old bonds in their possession. New government bonds are issued. But this time, rates go up. The old bonds then become less interesting than the new ones issued. What will happen? The financial markets do not want the old bonds. They prefer new bonds that are juicier. The European Central Bank will buy back these old bonds. But the financial markets will lose money on the sale of these old bonds compared to the original purchase price. To sum up, by a rise in rates, by inflation, we could see a bond crash.